This doesn't have to be a change in fundamental outlook for the equity market, but just near term, we might want to brace ourselves for a little bit of turbulence. Okay, a change in view from tactical strategies here. We are just tactically turning more cautious on risk. Why? 4 main reasons. The first one is just thinking about the market from a quantitative lens. We actually are seeing signs of euphoria bubbling up in various corners of risk right now. So obviously notwithstanding the fact that some semi-stocks have gone up 3x over the past month. But if we just look at the broader, more holistic view of equity risk, we can clearly see that there's a large amount of demand for calls rather than puts. So clearly there's a reach for upside rather than downside. The second thing is regarding just the fact that the S&P has gone up dramatically. And typically when we see this kind of magnitude of rally, it's reasonable to actually expect a pause or even a small pullback in equity risk near term. The third point is regarding momentum crowding. If you think about it as a factor, generally is something that investors want to be long. They want to buy things that are going up and sell things that are going down. But of course, over time, that creates periodic crowdedness, and then that in turn can be unwound. And that unwind doesn't necessarily have to be bad for equity risk. But at the moment, the issue is that the momentum factor and the market have become quite correlated. So if we get a drawdown in momentum, it could in turn trigger a drawdown in broader equity beta as well. And the fourth consideration is the fact that we have a new Fed chair. And history has told us, going back to 1930, that it's quite often the case that new Fed chairs oversee a period of market turbulence over the first 3 months of their tenure. So that's just also a consideration for investors at a time where complacency in general has crept up. And more importantly, investor conversations are very fully aligned with the idea that earnings are too strong to correct the market and the fact that they can't see what a catalyst is to get us lower. So the fact that investors are long and that we have gone up so much and that there is very little appetite to buy hedges at the moment is, in summary, the reason why equity trading strategies right now is turning more cautious on risk. So good old-fashioned mantra is hedge when you can, not when you have to. This doesn't have to be a change in fundamental outlook for the equity market, but just near term, we might want to brace ourselves for a little bit of turbulence. That's your morning matcha with Alty. Good luck trading.